Good day. Ira Epstein of Linn Associates with your financial market wrap-up for this Wednesday, February 10th, 2021. Getting out about 5:20 in the afternoon. I'm early today. But stock market up. It got a good piece of news. Fed Chair Powell was speaking today at the Economic Club in New York. Everybody wanted to see what he'd say. He wasn't going to come out hawkish. He was going to come out real dovish, and he did. And he's saying we need more COVID relief money. We need to keep businesses alive, blah, blah, blah. And when asked about inflation, he said, number one, it's not where they want it. Number two, if it does pick up and starts running and it's something they're not expecting, they have tools to contain it. In other words, they can always raise interest rates, pull money from the market. But he doesn't see that right now. The stock market likes that. Stock market wants to hear those good things. It wants to hear COVID vaccines are being passed out. It wants to hear things are getting better, not worse. It wants to get beyond the Trump impeachment trial right into the COVID relief bill and after that into infrastructure. So those are good things. Copper and gold up a little bit on the news. Foreign currencies down a fraction. But foreign currencies today had an interesting day. When we get to the dollar index, I'll show you. You've had a much bigger rally than I thought you were going to get in crude oil. Now, gasoline's breaking back as I'm expecting, and I think it's going to be in an interesting area for my paid subscribers. I'm not going to say anything more than that with it. They'll know tonight what I'm talking about. Natural gas up a little bit. Weather's still cold. Had a nice break, but didn't do that much damage to the chart. So let's take a look at what we've got. First off, remember this. This is a weekly area chart of only closing prices, not highs and lows of the week, just closes. And I run this average, the 18-week average, because it's my master filter. When the market is over it tells me I should be looking for buying conditions, not selling. Under, I should be looking for selling. Well, other than October, November, it's just been up and away, and that way for a long time. So it's done its job. It's kept me on the true road. The second thing I always look at is what's the chart action. Now, in the chart action here, we have a pattern that you can see we came down, shot up, and all of a sudden today, and I'll show you so we don't see tonight, we have an outside day down. Outside days are humdingers. They're really important. If you take out that high, it could mean that the market, in this little bit of a pause that it's got, is ready to advance to another number. If it's not taken out, it's offering a sign the market wants to back off, because the market, in this case, it's a key reversal and an outside day down. It's the highest of highs on the charts, closed lower, so that's the action on it. Excuse me. Do we have a trend? No. If you're like me and you define a trend, an uptrend, is higher highs and higher lows, you don't have that. You have a lower low and a higher high. You've come from there straight on up. That's why I created the swing line. I want to see what it's doing. If I come back here, you cannot tell me where the break lows and the rally highs are. You can say, this is important. Today, that's important. That's important. Nah, it's easier with the swing line. Boom, you know what you've got, and it's always the same. It doesn't get confused where we do. Where's the support then? Well, my theory, right or wrong, is that when a market's over the 18-day average and you break, that's often the support zone. If you get under that 18-day average, on rallies back up, you keep bumping into it as a resistance number. So it's the line in the sand. That's what you'll always hear me talk about, and that's where I see it. So if it wants to break down, that's one potential area. It doesn't mean it has to go there. Why? Because it's not trending yet. It still has the lower low and the higher high. So what about resistance? Well, we have the upper Bollinger Band, and it doesn't want to hit it. It's staying just away from it, so I can tell you which numbers they are. And if you're a subscriber, you know it's the third flip of the window envelope, or second or first, right? You know which one. I'm not going to tell these people which it is. And then you can lose those. Then you go into vertical price rises and so on. That's in my morning subscriber video. It's very simple to understand, by the way. So Kramer uses it. It's a deviation from a key moving average that you're using. Look at it that way, and you get levels of resistance and support. So I can see where the market's in something of a resistance zone. If the market takes out that high, I'm going to look for the 39.48 level. But something else has happened. There is a hierarchy on charts that I believe in. The hierarchy is which indicator takes on the most importance at a given point in time. Keyword, given point in time. When a market embeds, which is what the slow stochastic has done, it was overbought, and now it's had a series of days where all of a sudden the market's got settlement prices that are carrying the market each day where both numbers are going and staying over 80. Once that occurs, the market's changed its character. So I no longer worry about the swing lines. I'm now worried about an entry moving average that I don't show here. It's the same one all the time. And I'll be telling my clients where I think the pros are going to be buying. And I'm still looking for more to the upside. We'll see if that happens. That all changes if you lose the embedded reading by the red line closing under 80. It's even a better number than that one, and that's why I'm doing the enhanced course. For my original charting course, I'm now doing one that ties in the stochastics and the Bollinger Bands enhanced. Now you're getting to a much more advanced level that it's easy to understand again, and it gives you a set of parameters. Very easy, I think, to understand. When we take a look at the NASDAQ, first thing, embedded. Now I know my hierarchy, I got it. Higher lows, higher highs, outside day down, I'm bullish. Yes, I realize a trade top could be in. If you take that out, I'm looking for the 13,852 level, let's call it. But I'm expecting the pros to step in and buy the market until and unless that red line closes under 80 again. In the Dow, not embedded. Don't have the right amount of days yet to do it. Still in an uptrend. Today's action here was very different. You had an outside day up. You know, the other's outside day down, this up. So what you don't want to take out without being embedded is today's low. If you do, the odds favor the market is signaling it wants to get back down to 30,819. Those that would be playing, it's called a lost, it's not called the lost embedded, it's called a trade off an outside day down, just a reversal. The stop would have to be over today's high for those that would be pursuing that to the downside. Got it? You'd first have to make the low under Wednesday's low. You have to make a new low under Wednesday's low. Do I have the grammar right? Sounds like I'm not talking right here. Russell starting the roll to the right of the upper Bollinger Band, but embedded. That's not a bearish sign. Still a bullish sign. But unlike the other markets, if you were to take out today's high, which is also an outside day down, I don't know what to do with it. Why? You're already over the upper Bollinger Band if you're above it. Am I bullish? 3 of the 4. Bullish. VIX cash. VIX is telling me what? Well, the markets might want to be coming down a little bit here, but did we embed? So we come here, both numbers are under 20, both are under 20, and both are under 20. So nice as the rally is, until that red line closes back over 20, this is noise in a market that is still bearish. That's how I interpret it, which means it's still bullish for those other indices. In the bond market, you can see you're getting a bounce away from oversold, higher lows, higher highs. The most I'd look for on this market, if it can get up any momentum, is 168.15. That's a lot. It's almost a full point away. The market's got downside bias, oversold, swing line up. Confusing chart. In the 10-year note, it's a little easier. The resistance is the 18-day average. You hit 136.31.5 tonight already. 137 is that number, so that's your resistance point. Swing line up, momentum up, bias down. Close over 13700, and I think you get a bullish signal until you break back under Wednesday's low. Potentially, could be looking up here at 137.15. That's the potential for it. In the dollar index, for the first time since back here at the beginning of the year, the market had a pattern that it created of higher lows, and I think you can see basically higher highs. You paused right here from that high, but you didn't break the low. You've made a different game now. This isn't a pause. You broke down under this low. So I call this level to the upside done and finished with. That does not mean the market has begun a downtrend. It means that has ended, and now we're waiting to see what next. It ended between the upper Bollinger Band and the 100-day average, a good spot for it to end. And I look pretty good, luckily, that on these challenges of the Bollinger Band, I told you I think the pros come out up there. And I think they did. Now, the negative is I really want to see the euro do the same thing, and I'm not getting the mirror picture. I needed to take out that. It did a great job of holding the 100-day average and the lower Bollinger Band. It's still, though, in a swing line that is down. Momentum is up and bias is up, but that's not a trend. I need the market to do more than that. In the British pound, I'll let you buy over an upper Bollinger Band. I want to be on the other side of those trades typically because you don't stay over them more than 5% of the time. So I think the market's a bit rich here. It's not trending. You've gone from the lower band to the upper band. I think it's going to run out of momentum. We'll see. Am I bearish? No, but I'm not bullish. Bitcoin. Well, what can you say? It's just a runaway market. It's paying attention, and believe it or not, it does a nice job of paying attention to Bollinger Bands and the like. You can run them, but you'll get to that, generally that 5 level and turn away. What market didn't do that are the crude oil markets. They didn't pay attention at all to my rule of 5. You can see the Brent and WTI. You've now turned the momentum back up, which means Brent is widening away from the WTI oil. And if you look at the market, you had what? 1, 2, 3, 4, 5, 6, and today you closed 61.47. Well, that's right on the Bollinger Band. So you had 6 days in a row over it. You're embedded. That is strength, and I said that, but you normally don't get that. 5's it, and you roll to the right. You're rolling to the right now, but you know, it's just how it typically works. Again, it's all percentages. When you have the embedded reading, what are you doing? You're not looking to be a bear. You're not looking to say, oh, this is too high, now it's going to top out. You want to be a buyer on the opportunities that it provides you until the momentum is lost. That's how I interpret and teach charting. Doesn't mean I'm right, but that's what I see. Heating oil backing off a little bit, but it's much stronger than the gasoline market, which did break down. And in that gas, we kept the uptrend. The market has held it. It's not the strongest of markets. It's overbought. It did pay attention to the 100-day average and the formation of higher lows, higher highs. A lot of resistance, 299. I'd be a bit cautious here. Why? A market that doesn't respond to the most bullish thing it could have, this cold weather is unbelievable, and it's lasting cold weather. When it eventually breaks, you don't need as much nat gas. So is it going to respond to a bearish part of the news? That's what I pay attention to. Has it been an easy market to trade? In a degree, it has. The market has been with the clear-cut higher lows, higher highs. The dilemma's been, for me at least, that the market's been overbought during that. So did I get the setups I want? No. Did I know not to be short? Yeah. That's how you play with it. Today, the CME earnings came out, and they were talking about products that are making growth happen at the CME Group, which is where most of you trade. I mean, that's Chicago Mercantile Exchange, Board of Trade, the NYMEX and all. They own all that. So, you know, one of the things they're talking about, if you went in and you could read the scripts as to how the conference call went, is the growth of these mini indices. When it came out, I told you it's going to be a monster. It's their most successful mini product I've ever seen in this. I'm talking the micro minis. Yeah, you know, these are 1/10 the size. So you get a margin of $15,000 on a contract. $1,500 to trade this. Same chart pattern. The moves are 1/10 the size. So what we did and what the exchanges did, we all adjusted the cost. And what's the cost? $1 a side per trade. So it's $2 round turn plus reduced. Well, I don't know if the NFA reduced it. Their cost was 2 cents. The Merc, I know it's a reduced cost through that. Come on, this is pretty interesting. How do you get started? It's simple. type in on your web browser, iraepstein.com, but /micro. Everything's explained there. Or call my staff. They can get you all set up too. You open an account, away you're going. And I think you'll find that it's interesting in a great way. If you're new to the markets, 1/10 size, this is where you want to get your feet wet, in my opinion. I'm Ira. You have a good day. Talk to you later.